that increases your borrowing capacity by several times, and some may even say that it leads you to infinite borrowing capacity.
This client has lost over $500,000 of borrowing capacity because he has access to $84,000 of credit cards. Welcome back everyone to the Finance Matters podcast. If you've forgotten already, it's Adrian and Rahul from the Lenders Club. As you've seen across Australia with the RBA and interest rates, a lot of people are worried about their borrowing capacity dropping because of these changing rates. So today we're going to talk about how to increase your borrowing capacity. So Rahul, do you want to go through the first topic on how clients can help increase their borrowing capacity?
Yeah, so this whole thing comes up from increasing rates every day. So RBA has been kind this month. They put a pause on interest rates.
Oh, for the first time in 11 months.
I know.
Come on.
So that is sort of a relief. But then the problem remains the same. The borrowing capacity is going down because the interest rates are going up. So that is number one point. So let's say if you are going for a loan and your bank is offering you 5.25% interest rate, and there is another bank which is offering you 5.05% interest rate. So that difference of 20 basis points can mean that if you go with the lower rate, your borrowing capacity would be higher by $20,000, $30,000, $50,000.
And I assume that's because your repayments are going to be lower.
Exactly.
With their additional surplus.
Exactly.
I believe that with each 25 basis point increase, you're losing a $40,000 of borrowing capacity. So with 11 increases, that's $440,000 people have lost. So reducing your interest rates, giving you that extra surplus with the monthly repayment, as you said,
exactly.
Increase.
And speaking of this, on the same topic, like let's say you have an existing loan with one bank, and that rate is 6.75%.
What are you going to do about it?
Or 6.15%, let's say. Now, because you are on that higher interest rate, if you refinance that or bring the rate for that existing loan down to 5.75, 5.65, 5.25, whatever extra gap you get by doing that, or by refinancing that loan to that lower rate, that will also boost your borrowing capacity a lot.
Of course, well, we need to reduce that interest rate. So whether it be at the same lender through a pricing request or a complete refinance, you may not be happy with where you are. The rate may be too high, you might not be happy with the bank you're with. So definitely speaking to your broker about refinancing, getting you a better interest rate, and what else they can do for you, possibly cashbacks and things like that. But two ways to help increase your borrowing capacity. Third one that we see every day without fail, credit cards. A majority of people have them, but they can kill your borrowing capacity. To give you an example, I have a client with $84,000 worth of credit cards. Now we know the credit cards work in a multiplier of 6. So if you have a $10,000 credit card, you're going to lose $60,000 of borrowing capacity. So quick recall, 84 times 6. I beat you to it. It's 504.
I know that.
I still beat you.
Okay.
This client has lost $504,000 of borrowing capacity because of his $84,000 credit cards.
But what does he use $84,000 in that, or how much of it does he use?
Not a lot. It's mostly paid off. But the banks don't care about that. If you have $84,000 limit and you make your repayments on time, you're never late, yada yada yada, they will only look at the limit, which is $84,000.
So it doesn't matter what you use of that. Even if you have, let's say, a $10,000 limit, your borrowing capacity is down by $60,000. So you would say that it's best to close that credit card if you're not using that, or reduce the limit to increase the borrowing capacity.
Reduce or completely close, and you will see your broker will tell you your borrowing capacity will completely change.
Okay.
We do that every day.
Cool. What about let's say if I have a personal loan or a car loan? How does that work?
Personal loans and car loans work in multipliers of between 2 and 3. They differ. So a $20,000 car loan, you'd be reducing it by $60,000. A lot of people have car loans. It's understandable. You can't just close it like a credit card. But these are things to keep in mind when you are going for a home loan and saying, well, I earn all this money, I have such good income, I save, but you've got 2 car loans between yourself and your partner. You may also have a couple personal loans. We do see this all the time. Clients may take out like small personal loans.
Yeah.
It still can reduce their borrowing capacity. They're just unaware of it.
Yeah. So speaking on the same topic, if you have an existing loan, a home loan, and you have equity in that home, if you want to increase your borrowing capacity, there is another option where you can consolidate your 10%, 11% personal loan, car loan into that home loan of 4, 5%, 6%, and reduce that extra gap and increase your borrowing capacity by just consolidating that loan. So you can make a separate split in the home loan for, let's say you have a car loan of $30,000, get your bank to do a separate split of equity of $30,000 for you for 10 years. So by doing that, you are still paying off your car loan in 5 to 10 years and still having a lower interest rate on that.
And the car is then not financed.
Exactly.
It is attached to the house.
Exactly.
As well. Or we also see clients that pull out equity to completely pay off these loans because of the high interest
Yeah.
rates. So other ways to help increase your borrowing capacity. Now, another thing that we see all the time is the buy now, pay later schemes.
Yeah.
Your Afterpay, your Zip Pay, your Latitude, I think have gone under now, or resulting in unnecessary spending.
Yeah.
You see it all the time. I see it all the time. What are your thoughts?
Yeah, so this one is not just about buy now, pay later, but it is about what they allow you to do. Now, because of Afterpay, Zip Pay, you can pay in 2 months, in fortnightly repayments or something like that. So that means that you can just go on a spending spree. So without knowing, your living expenses have gone up. So banks will look at that and be like, okay, you are spending more than you have to, than a family of your size. So that decreases your borrowing capacity again.
Correct. That's right.
So that is what you should just, if you just close those, you would not spend more than you need.
Exactly. Nice and easy. Now, another thing I want to talk about, we did touch on refinancing before, but I want to talk about a different type of refinancing, which is refinancing back onto the original loan term. Now, if you've got an existing loan and it's 25 years long and your borrowing capacity isn't that strong, what you are able to do is you are able to look at refinancing to another lender. Obviously, we'd be looking at a lower interest rate, but refinancing that same 25-year loan term back onto a 30-year loan term. Now, obviously, the extra 5 years of interest payments is going to be something that we need to have the client consider. However, because we're now splitting your repayments across 30 years and not 25 years, that actually reduces your monthly repayments. So for example, if your monthly repayments are $3,000 a month on 25 years, and we are now increasing it back onto a 30-year loan term, those $3,000 of monthly repayments could be split into, say, $2,200 per month. So that extra $800 per month can be added back onto your surplus as it's funds you are not spending toward a liability. So that's another way clients, and we've done it for many clients, they've refinanced back onto a 30-year loan term, it's boosted their borrowing capacity, and they're now able to purchase another property, whatever PPR or an investment. So another thing to think about.
Yeah, so just to make it, just to simplify that, let's say you borrow $100 from your friend and you have 5 months to repay him back. So you repay $20 to him each month. And now, let's say you just extended the term to 10 years. So now you have to repay him $10 each month. That is what it is. It allows you extra $10 space to use in your budget.
Exactly.
Yep.
Great example. So we see this all the time, which is mostly for people that have existing loans to help boost their borrowing capacity again. Now, we've got one more thing that we want to talk about. I know that you are quite excited to talk about this one.
Cannot wait.
Borrowing within a trust.
Yes.
Yes, very specific and special topic, but I know you're itching to talk about it, so run us through.
Yes.
Run us through borrowing in a trust, Rahul.
Yes, so what happens so by no means this is finance advice, and we are not finance or tax advisors, and borrowing under trust needs both And this is specifically for investors who want to build up a large portfolio. So this has been around for quite some time, but this is becoming more and more fashionable and trendy now, because this is becoming a problem now. People cannot borrow as much as they wanted to. So what borrowing under a trust allows you to do that, let's say you buy a property under a trust, and that trust is self-sufficient, which means it can afford all the expenses, and by the income it gets on its own. And you can just get an accountant's letter stating that this trust is self-sufficient and it can pay off its own liabilities on its own. The banks, there are several banks and lenders who will not look at that liability as your personal liability.
So it's separate.
Exactly. They will classify it as a separate entity. That trust is a separate entity. You are a separate entity.
Because it is self-sufficient.
Exactly.
Okay.
So
Interesting.
that increases your borrowing capacity by several times. And some may even say that it leads you to infinite borrowing capacity. But again, this is not.
It's a big claim, Rahul.
It is also very possible, but it depends on the climate as well.
Of course.
Like these days, there are several lenders whose policy allows us to do that. But who is to say that in future they don't change that policy?
It could change, but for now,
Yes,
it's technically possible.
it is still possible. We are still doing it for a lot of investors
Yeah.
who are borrowing under trust. They are making most out of that. Like I had someone who bought 4 properties in the last 4 months, and then his personal borrowing capacity is still intact
Unaffected.
at all. No changes to that.
Beautiful.
Yeah.
Well, those are some ways of how to increase your borrowing capacity. Hopefully you guys have learned something today and it's helped you. Obviously, if you are looking at purchasing a property and you're wanting to increase your borrowing capacity, any one of these things can help do so. So look at your situation, look at your financials, and see what you can do to help increase your borrowing capacity.
See you next time.
Take care.